Hi, welcome back to another episode of Hoot and Poop. So in today's learning series, I will be talking to you about the investor's mindset. Okay, so basically when we talk about investing, I believe there are tons and tons of informations outside, that talks to you about what are the different companies about, how do you value them, how do you look at their matrices, financials, etc., and so on. So I'm not going to go through that, like how to read an annual report or cash flow statements or balance sheet and stuff. It doesn't matter to me because it's a lot of info out there. But what I wanted to talk about today in today's video is more of the mindset, the mental capability of being an investor. Okay, so if you think about it, right, it's actually pretty how would I put it? It's actually pretty easy to make money in the stock market. You have various kinds of investors, including traders. So if you are a trader, okay, you have the right techniques, the right tool. Okay, I'll put it this way. If you're a trader, you use a consistent one single tool or a few single tool consistently, okay, you will, in the long run, you will be able to make a profit because your buy and sell will based on that few technical systems and tools to do it. So that's for technical aspect. Now, if you look at fundamentals, if you go and deep down research on the company, and if the company passes a few very basic stuff, for example, the company's revenues are growing, if the company has sound management, if the company is improving year on year with all the matrices, reducing in terms of the debt and increasing number of cash, over the long run, the company will do well. Okay, unless there's a black swan or whatsoever. But what actually kills us is all about the mindset. Okay, it's all about how we how can we endure volatility? How can we endure when short report comes about? How can we endure seeing red in our portfolios? So these are things that to me it's very crucial. And because why is even more crucial is that when I talk to friends or people who are invested in the stock market longer than me and so on, but they still admit that the mindset is actually one of the most problematic obstacles that give them in terms of long-term holdings per se. So in today's video, I will be talking to you about three mindsets that I want to highlight to you guys. So time tolerance, returns of expectations, as well as capital dependency. So let's move on to the time tolerance portion. So firstly, being an investor, okay, you need to understand, what is your time horizon. If let's say, within 1 year, you wish to maybe grow your portfolio in 10%, 20%, and so on, then you have to ask yourself, is this something that it's possible or is it not possible? Even if it's possible, what are the stocks that you can buy? I mean, I'm pretty sure if you want to have, let's say, 20-30% of return within 1 year, I'm pretty sure you cannot go for stable companies like perhaps maybe Microsoft or maybe Amazon. Okay, these companies, right? I actually never go and dive into what's the ROI, but this is just an estimate. Or rather, in fact, if your time horizon is 20% or 30% in 1 year, I don't think you can invest in the index, perhaps. So you have to ask yourself, what is your time horizon now? If on the other hand, for my case, my time horizon, right, rather my time tolerance is, let's say, 5 years. So within 5 years, I hope on the average on annual basis, 20% or 20 to 30% ROI. So now then, this makes it possible because why? If within 5 years, you do see a lot of companies, they went all the way up, perhaps in the third year, fourth year, and the growth is not how do I put it? It's not linear, it's exponential. Okay, so this so on the 5 year time scale, perhaps it is then possible to have a 20 to 30% ROI on a yearly basis. And then the next question, is that this whole time tolerance things is that if you have shorter time tolerance, then perhaps micro cap may not be suitable for you. Now, what do I mean by micro cap? Micro cap means stocks that are less than probably a few hundred millions, let's say less than 3 billion. So because microcaps are very volatile. So, within 1 year, 2 years, you may or may not get that kind of return, but most of the time, it's not always that possible for within 1 year. So understand your time tolerance. And if you're really short term, okay, then perhaps microcap may not be that suitable, because if you talk about long-term investing, you need time for the company to grow. Because don't forget, when we are investing, we are not just investing in the stock market, we are investing in the company, and the company needs time to grow. So this is the first thing you have to be very honest with yourself. What is your time tolerance? Okay. Now the second portion is that, what is your returns expectation? Okay. So like I mentioned, some of us may have won 20%, 30%, 10%. So you have to be really honest with yourself. And this goes down to, your age as well. So let's say, for example, if your portfolio, right, is a 1 million portfolio, and if let's say you are 50 years old this year, okay, now, do you still need a 20% ROI? Or do you just, are you comfortable with just a 10% ROI on a year-to-year basis? So this is something that, nobody can advise you. It's really based on your lifestyle, based on what you want, based on, what's your portfolio like. Because you think about it, if you're 1 million, 10% of 1 million on a year-to-year basis is actually pretty decent to live on, to be honest. I mean, if you ask me, I really think that 10% on the 1 million, it's pretty decent return. And it's quite significant if you think about it. So this is something that you have to be really honest with yourself. What is the expected returns that you need? Okay, so to help you out, what you can do is that, if let's say you are, maybe at your retired age, okay, then it's more of like, how much do you need on a perhaps a year-to-year basis? Okay, then you base on your current portfolio, and then you see what's the ROI you need to survive, to enjoy your life. Okay, so that's for the expected return. Now, on the other hand, if you are perhaps maybe 20 plus, 30 plus, we just started out working, okay, you would want to achieve a ideal lifestyle like that you desire, perhaps maybe a full-time investor, maybe pursue some hobbies, and you probably need a large flow of money back in the future. So because of that, you may want to have a higher ROI. Okay, so to do so is the same as, look at how much money do you have, okay, and from there project how much money you roughly need, okay, and then you just book back an ROI of or rather than expected returns on a year-to-year basis, and this shall be your benchmark. So this is something that you have to set for yourself. Okay, now the third point is capital dependency. So this is perhaps one of the more important mindset that I want to drive at, is that number one, when you're investing, some of us can be investing as a sideline. We still have our 9 to 5 job, we still have our businesses to run. Okay. Well, on the other hand, some of us would have really been retired, and investing would be our bread and butter per se. So this is how. So if you think about it, like for those who are in the first category, when you are like still a businessman, when you still have a job, okay, when you still draw salaries or you still have a certain flow of income, your dependency on the stock market to give you the capital is actually pretty low compared to if you are a full-time investor. Okay, so why do I bring this up? Because if you are very dependent on the stock market's returns on your capital, then perhaps it may not be wise for you to choose a riskier company, a unproven company, or a company still developing at the proof of concept kind of stage, which is something like microcap perhaps. Because the point is that microcaps or companies that are still growing, or rather growth stocks, they are actually really, really very, very volatile. You look at Arcade for a moment when they just launched, it shot all the way up to 30 plus to $40, coming all the way down to $16. So now the thing is that if your capital depended on the movement of the stock market, the returns of the stock market, seeing such a swing, and if you are pumping in a huge significant money inside, it is really very traumatizing for you as an investor. But on the other hand, if you are still working, you still have cash flows coming in on a regular basis, then perhaps you may be able to accept such swing of coming from the market. So so that's why what I'm trying to drive at for these 3 pointers is that you have to be really honest with yourself, understand, be true to yourself. What is your time tolerance? What's your expected returns? As what's your capital dependency? Look through them, ask yourself, be honest with yourself. Then after that, look at your investments to see whether are you placing your investment based on your own expected, whether your own criteria. So for example, for my case, my time horizon, every investment that I make is about 3 to 5 years. That's the minimum time that I set for myself when I go in. My expected returns is about 20 to 30%. This is based on my current capital. And if let's say I would like to retire or be financially free, within 10 years time, for example, so 20% to 25% is pretty much where I'm looking at. And third point is the capital dependency. So currently, I'm not a full-time investor yet, so I don't depend on the stock market for my capital, my daily necessities, my living needs. So basically, I'm not so that dependent on it, so I can take volatility. So these are questions that you have to be honest with yourself. Ask yourself first, and then once you find the answer, you will be able to guide you through the stock market. And when you choose the company, right, always remember your criteria, because your criteria will determine whether or not to take on certain risk in terms of the investment portfolio that you're looking at. Okay, so I hope this gives you a clarity in terms of the mindset that I'm trying to drive at. Okay, and if you enjoyed this video, I really appreciate a like and subscribe, all right, to my channel. And I'll see you in the next video. Invest safe.